In Chapter 5, I wanted to touch upon just a few of, I think, some of the more salient points in the chapter regarding exclusion of gross income. As always, I encourage you to read the entire set of PowerPoints as well as the chapter and the text. But I think it's worth mentioning a couple of things. First, that the life insurance proceeds received, especially on term policies, are not taxable. And the point I wanted to mention regarding these life insurance proceeds on the term policy is that the relationship to the decedent is not determinative. That is to say, it does not impact whether or not these life insurance proceeds are excluded from income. If the nature of the life insurance policy has a cash surrender feature and the insured decides to redeem the policy, then to the extent the proceeds from that redemption exceed the amount paid in premiums, that amount is taxable, and that represents a taxable gain. However, if the proceeds received on the life insurance policy are less than the premiums paid in and a loss is incurred, a realized loss, that loss, however, cannot be recognized. And also it's worth mentioning, I think, that accelerated death benefits is a feature that the tax code acknowledges is important for chronically ill or terminally ill individuals who want to take advantage of the life insurance benefits, even though, of course, they have not yet deceased, because of the burdensome medical costs that they are bearing. And so the tax code does allow exclusion of these benefits, even if received before death, as long as they're used to care for these terminally ill or chronically ill individuals. On scholarships and fellowships, amounts paid on the student's behalf, if those amounts are used for tuition-related expenses, then that income is not included either, or is excluded. However, if a student uses fellowship dollars or scholarship dollars to cover room and board costs, those would be, to the extent that those funds are used for those purposes, then that would be taxable and included in income. And the thinking here is that the room and board would have been incurred, these costs would have been incurred, irrespective of whether or not the student was pursuing educational goals. Compensation for injuries and sickness. If in litigation, for example, the plaintiff sues and is awarded compensatory damages, these damages are designed to make the plaintiff whole, to return the employee to the position they were before they suffered the injury or physical sickness, then those damages received are not taxable. However, if compensatory damages for non-physical injuries or punitive damages are received, then those kinds of damages are taxable. And punitive damages might be damages that are over and above compensatory damages, but are designed to discourage others from engaging in the defendant's behavior, or as an incentive to the defendants not to engage in this behavior again. So those, to the extent that the damages represent punitive damages, those damages are included in income. On the employee side, if the employee receives accident and health insurance benefits by the employer, then they generally are excludable, even if the employee has the option of taking the coverage or enjoying a higher salary or hourly rate. So when employers pay these premiums for the insurance coverage, the dependents are covered as well as a spouse, and so those insurance premiums that are paid on behalf of the employee are not taxable. There are annual limits, and I'll talk a little bit about these annual limits on long-term care insurance. So the exclusion of benefits received from the policy is limited to the greater of $360 in 2018, and that amount does change over time, or the actual cost of the care. And of course, those costs of the care would be net costs of care, because we'd have to exclude any insurance recovery on the actual costs that we incurred. Been a change as a result in 2017 Tax Cut and Jobs Act on the meals and lodging side. As much of the Tax Cut and Jobs Act, these provisions that I'm about to discuss are only applicable from 2018 through 2025, and then they revert back unless Congress intervenes between now and 2025. And here the employer may deduct only half of the cost of meals that are provided for the convenience of the employer. Previously, if the employer provided meals because they wanted their employees to remain, for example, on site, and so it was more convenient for the employer to have the employees there. It served their interest to have the employees there, so they provided meals for them. In the past, 100% of that cost that the employer bore by providing this benefit were deductible and therefore excludable from income on the employee side. However, again, from 2018 to 2025, that changes, and only half of the amount of this benefit is excluded from the employee's income. And I think it's worth noting that after 2025, employers may not claim any deduction for these meals. If the employer provides dependent care coverage, then up to $5,000 of those costs paid by the employer can be excluded from income. There is an exception to that, and that is if the employee happens to earn less than $5,000 from the employer, but still receives $5,000 or more in dependent care, then the limit would be their income. So, for example, if an employee earns $4,000 and receives $5,000 in these dependent care costs, then $1,000 of that would be subject to taxation by the employee. Cafeteria plans, these allow employees to choose between cash and certain non-taxable benefits. So if an employee decides to opt out, for example, of life insurance coverage or health insurance coverage, and they decide to take a cash benefit, then that cash benefit becomes taxable. However, if they take a non-taxable benefit like health insurance premiums paid by the employer, then those benefits remain non-taxable, even if the employee has a choice. That's one of the greatest benefits of these cafeteria plans. On the flexible spending plans, these are plans that allow employees to accept a lower cash compensation in return for the employer agreeing to pick up certain costs of the employee without the employee having to recognize income. So when these plans are available to the employee and these benefits are not used, either within the calendar year or 2.5 months after the calendar year ends on December 31st, then those amounts are forfeited and they cannot be recovered. Other kinds of non-taxable employee benefits that you should be reviewing in this chapter, I'll just mention a few of these. One of these that I want to mention is the no additional cost services or qualified employee discounts. Especially on the employee discount side, if you receive employee discounts on inventory, there are limits. Generally 20% of the gross profit is kind of the limit that in terms of the discount that can be provided without triggering a taxable event. Also, as a result of the 2017 Tax Cut and Jobs Act, qualified moving expenses now are only available to military personnel. So moving expenses used to be a 4 AGI deduction for everybody if they qualified. That's no longer the case. Like most plans, no additional cost services or employee discounts, they're only excluded from income subject to all of the previously mentioned conditions. They're only excluded from income to the extent that they're non-discriminatory. That is, they're offered generally to everybody in the same under the same plan. So if these non-discrimination provisions such as employee discounts are only offered to highly compensated employees and not to everyone else, then this is taxable income to the people who receive this benefit. Dividends, for example, from corporations are taxable as dividends to the extent they either are taken out of current or accumulated earnings and profits. And earnings and profits is a concept very similar to equity or retained earnings on the financial accounting side. So if the dividends are taken out of current or accumulated E&P, then generally they're taxed as dividends by the recipient of the dividends. If, however, the dividend is not exceeds, for example, current and accumulated earnings and profits, then that represents a return of basis. And then to go one step further, if the dividend exceeds either accumulated or current earnings and profits and the basis of the stock, then the excess over those two thresholds is treated as a capital gain. If an investor receives stock dividends, then generally stock dividends are not taxable. It's really just like a division, further dividing of the equity into more pieces, but the amount of equity really hasn't changed at the time of distribution. However, I want to mention that if the shareholder has the option of receiving stock or cash, that triggers a taxable event on the stock options. And so then if they have a choice and they decide to accept the stock options, now those stock options become taxable. Educational savings bonds, if those proceeds on Series AA U.S. bonds are used to pay higher educational expenses that are qualified, and generally to be qualified, the educational institution, one has to be generally approved to receive federal loans. Also, the educational expenses are defined as qualified, and they have to be used for tuition, books, and things that relate directly to the educational costs. The bonds have to have been issued after December 31st of 89, and then the bonds have to be issued to persons at least 24 years old. For qualified ABLE programs, this is a benefit that your employer or your clients should be aware of. That in 2014, a new type of program was created that assists individuals who become blind or disabled before the age of 26 to receive benefits from these 529A plans. And ABLE stands for Achieving a Better Life Experience. So we know 529 plans are designed to set aside funds for educational costs that are tax qualified. That is to say, they don't, the interest or earnings on those proceeds, if they're used for educational costs, are not taxable. Well, these state administered programs allow then the investor or the student in this case who becomes blind or disabled before age 26 to use those funds for costs other than educational costs. So without penalty, of course, without penalty. So there is this exception regarding these 529. One of the overarching themes in this entire chapter is the tax benefit rule, which states that if a taxpayer claims a deduction for an item in 1 year and then later receives recovery of at least a portion of that deduction, they need to report that as income. So, for example, if someone deducts their state income tax as an itemized deduction the previous year, and then they receive a refund of at least part of that back, then that portion of the refund that exceeds the standard deduction is included in income. If you have any questions on these or any of the concepts that we discussed in this chapter, please let me know.